Welcome to the TEK2day podcast, powered by CEO Raider. It's your host, John Maeda. Let's kill two birds with one stone. Our two most recent TEK2day articles. And by the way, we have a new feature. So if you visit TEK2day, particularly if you visit on a laptop, we added sort of a trending feature so you can see which articles are most popular. That's in the right-hand margin. If you're scrolling through on a mobile phone, I can't remember off the top of my head where that appears. I believe it's at the bottom of the page. So we published, the first article covers one that we published this evening, entitled "The Fed Won't Change Its Position on Wednesday." There's really not any new thinking of ours in here. It's just what we've consistently been saying, that Powell and company will continue to run their inflationary policies to inflate away the debt. He'll talk of, in Wednesday's press conference, he'll talk about transitory inflation. He'll talk about, most likely, the low labor participation rate of, what was it, 61.6 in May, which was down 1/10 of a point from April. So we're still near the trough in terms of labor participation, which is why I say it's a rather weak economic recovery. Sure, we have spending because we've floated helicopter money to people into businesses. So they're spending, but we're not producing. And we have too many people sitting at home collecting a welfare check. So that it's hardly a setup for a strong economy. And as this rebound from the COVID trough starts to subside next year and further again in 2023, which is when you'll start to see normalized GDP. We believe real GDP will be essentially zero. I think the Biden plan calls for something between 1.8 and 2% real GDP from 2023, 2024, thereabouts, through 2031. And we believe inflation will persist through that period, and so therefore you have stagflation. So you can read more about that. And there was another couple of pieces we put out there early yesterday morning. And so there's probably half a dozen articles we put out around macro-related content in the past 4 or 5 days. And then tomorrow morning, first thing, we put out a piece entitled "Investors Should Ask More of Their Management Teams." So that will come out Tuesday morning. And what we go on to say is that one of the great distortions caused by the joint fiscal and monetary policy of 2020 and 2021 is that equities and the lowest rated non-investment grade bonds are two of the all too rare places where investors may earn a return. And as a result, equities have been goosed over the past 14, 15 months. They were already trading at rich valuations in 2019, but now they're at nosebleed valuations. So there's a lot of room for equities to pull back. And it's not going to take much, in my view, in the way of an interest rate increase to knock equities off of their pedestal. As I've said in the past, you're not going to see interest rates go to where they were back when I was a Hale bond analyst. Fed funds rate was 5.5% in the late 90s, 97, 98, 99. And obviously we could not afford that now, given where debt is. The country could not afford to service the debt, the interest expense. But they'll come off of the floor. Fed funds is, I can't remember where it is off the top of my head, but it's basically at zero. So what we say in this article is that management teams have received a pass, if you will, from investors, given that equities have largely been straight up since April of 2020. And so you've got companies doing goofy acquisitions at goofy multiples, acquiring assets that don't make sense. And the one that we call out, we've called this out in the past, is Roper Technologies, ticker ROP, where it's technically it's an industrial company, and they do have a software unit. I think they have a good guy running the unit, but I think the guy running the company was probably not so great. Definitely not so great, in my opinion. They've got a compensation plan, in my view, that's geared toward enriching the management team, and we talk about that in a separate article, maybe published in early last year or late 19. If you run a query on Roper on our website, you'll find it. In any event, it's one that rewards the company just for absolute EBITDA growth, right? So when that type of compensation plan passes the compensation committee, what ends up happening is you get a lot of short-term action in the way of M&A activity, whereby companies just are trying to roll stuff up. They're trying to find target companies that can goose EBITDA, which in turn will goose their compensation and their options packages and their restricted units and their performance restricted units and so forth, RSUs and PSUs. Whereas the proper thing to do would be to find companies that can drive, in terms of acquisition targets, that can drive long-term sustainable growth. And the one they acquired last year, they being Roper, was Vertafore, which I looked at on the M&A side maybe 8-9 years ago. Historically, Vertafore had always been sort of a no-growth revenue company in terms of organic revenue growth. And it had a ton of debt. I don't remember what the number was off the top of my head. When Roper announced this deal last year, I looked at the number on Moody's, and it was carrying a ton of debt. And I don't know how much of that debt Roper paid down when they closed the deal and how much is still on the balance sheet. I just haven't looked. But that's clearly an example where you're acquiring a sort of a legacy technology insurtech company that, albeit while it is sizable from a revenue and EBITDA standpoint, it's not terribly strategic. It's not going to drive long-term growth. It's not going to accelerate growth. It's going to be a drag on growth, frankly. And it's going to be a drag on profitability in the long term because you're going to have to freshen or refresh the software. I don't recall because I wasn't interested in Vertafore, so I don't even know if I asked a question around, if you looked at the portfolio of products, what's the technology stack look like? I don't know how much of Vertafore sits behind a firewall. I don't know if it's all cloud these days. I don't know if what cloud means exactly. Is it public versus private versus mixed? Whose servers does it sit on? I don't know any of that stuff. But I imagine a lot of the architecture is still long in the tooth. And so this sort of gets back to what we've always said around why I founded CEO Raider and a couple of the videos that I posted last week with Liberty Media's John Malone. John Malone being Liberty's founder and chairman, and the piece I put up from Berkshire Hathaway's annual meeting back in May with Warren Buffett and Charlie Munger, where Malone and Buffett separately talk about the management team as being the key element to a company's long-term success. Malone goes on about it in some detail for about a minute, and then Buffett talks about the management teams in general as the primary risk of a company not working out over the long term. And how many times have I seen that as an equity analyst and others with similar experience to me, whether equity research analyst or private equity executive or venture executive, where you have a CEO who, earned the spot on personality. If we think about my experience with technology companies, and less so on merit or technology chops, and he or she works himself into the CEO chair, and the company does poorly or it does okay, but you have this issue of opportunity cost. Right? Anytime you have a sort of an average CEO, there's always room for improvement. And that's what we say in this article here. Hey, although all these stocks have run over the past 14 months, from an operational standpoint, what have these companies done that's worthy to deserve those valuations? So particularly if you're a large holder, be tough on these companies, even if you have a good relationship with them. What are they doing to drive organic revenue growth? How do they reward their product managers and their technical staff for building products that are easy for the sales force to sell? So how do they incent organic revenue growth? How do they reward people? How is variable comp tied to organic growth? And how many people have compensation at risk that's tied to organic revenue growth? Is it just the various general managers, business unit heads? Is it all the way down to the front lines? How often do they have op reviews, these various companies, with their various business unit heads to cover each business in detail? What's covered in those op reviews? Do they even have them? So there's a whole slew of questions you could ask, particularly as a large holder when you talk to these companies, when you meet with these companies. And I just don't know. Frankly, it's a lost art. There's not a lot of institutional investors that would even know how to drill down and ask relevant questions as it relates to what companies are doing from an operational standpoint to drive long-term operational success. But if you want help, turn to us. Send me an email, jmayetta@CEORadar or info@CEORadar, and we can help you there. That's all for now. See you next time.